Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the recent manifestations of distorted monetary and government policies as they've had on the economy and what to expect in the coming years. Of course, I have been producing several videos on this, but I think I can finally narrow it down as to what we can expect in the next 2 to 3 years. So my mind was kind of teeter-tottering between a few things that could play out in our markets, especially as to what would derail our economy. The first one is obviously high inflation. And the reason why is because high inflation, when you have those prices being bid up in the wake of more conservative monetary policy, it can lead to sort of a liquidity crisis inside of the economic sectors as businesses suddenly find themselves short of cash to buy materials, goods, and resources in order to make the final good for the consumer. And typically when that happens, we get a collapse in the economy. And number two is that we can have a situation develop where businesses that were relatively unproductive but were managing to hide their unproductivity and their losses by buying more and more money through easy credit and easy money because interest rates were so low and cheap and funds were available. All of a sudden those funds start drying up, and then they have to finally close down their business, lay off those workers, and of course that causes, on a technical basis, a slowdown in the economy as those workers are laid off and there's more unemployment and there's a drop in consumption. And then three was that we would have a liquidity crisis in the banking system, which I've covered also in the last two videos, and that's basically because the Federal Reserve's tighter monetary policies will dry up excess funds in the banking system. Since then, I think I've been able to come down and deduce that it's probably going to be a drying up of bank reserves inside of our banking markets that will occur first in the early parts of 2024. Now, as going over the other two scenarios, that is that we have higher inflation that causes a bidding up of prices and it gets to become a shortage where essentially businesses run out of materials. That was something that happened in the very late 1920s, and it is theoretically possible that that could happen now. And if we do see that, we'll see a very sharp spike in short-term interest rates, very much so. It will be difficult to anticipate that happening, and I will say that it is theoretically possible with the recent geopolitical situations that have developed between Russia and Ukraine, the U.S. and NATO sanctioning Ukraine or sanctioning Russia over Ukraine, the fact that Ukraine's production of wheat and other agricultural commodities has been destroyed, the cutoff of supplies of oil, and the driving up of prices there. It is possible that for certain essential commodities, especially if we get into another Cold War with China, that we might see some type of artificial shortage of necessary resources to complete our goods and cause a crash in the economy. Taking that out of the equation, because that's really unpredictable, the only other way to predict a crash in the economy is to watch the defaults and delinquencies on loans. Now, in previous videos, I've told you I've created a model that predicts defaults and delinquencies on loans, but if you notice here, there's a time lag between the rise in my model's indicator and the actual increase in defaults and delinquencies. So what I have done is adjusted my model for that time lag, okay? And this is key, because by adjusting for the time lag and then taking the difference between the remaining gap, I can now effectively give a pretty good prediction on when we can start to see defaults and delinquencies, which is measured here on this chart in red, start to rise and reach a point where it will become too dangerous or too much for the economy to handle. There's too many businesses, too many people going bankrupt, the loans are not being paid back, And that's going to feedback loop into an economic recession as layoffs occur, there's more unemployment, there's a drop in consumption, and we measure our economic growth in terms of consumption here. And, to skip all the hoopla about it, it looks like it's going to manifest that the model, once you adjust for it, will manifest in 2025. Now, why do I say that? Well, the model, adjusting for the time lag, will start showing that delinquencies and defaults on loans will start moving up in the third quarter of 2023. But now there's still about a 6-month time gap, judging by the last time we had a credit bubble burst. And this 6-month time gap would mean that defaults and delinquencies will rise to the critical point in the first quarter of 2024. But once they do start increasing, once you start seeing those defaults and delinquencies rise to that critical point, you must then allow for, say, another year, another 6 months to a year to pass before we actually start seeing that manifest in the aggregate economy in terms of deteriorating economic growth, to the point that the Bureau of Labor Statistics stats on it, sees that it's pulling in the economy down into a recession. So, the earliest that I see the economy going down into recession is at the end of 2024, say quarter 3 or quarter 4. But if you've been watching my videos, I have been saying that in the first quarter of 2024, bank reserves are basically going to dry up to a very critical point based off of, math, that essentially means that banks are just not going to have enough money to maintain operations, given the fact that, governments are collecting record amounts of taxes. The Federal Reserve is unloading purchases of their securities back to the banks and sucking out that liquidity. And the big one is that the deficit, the amount that government is permanently taking out of bank reserves and then spending that out into the economy, driving up prices, is really going to deplete those bank reserves in the next 2 years. The first year will be absorbed by the Fed repo market, because if you look at what's been going on in the repo markets, and let me pull that up for you. Let's see here. We want Treasury securities sold. Those Treasury securities that are sold in the repo markets now is amounted up to about $1.6 trillion. And the Fed is doing this daily on these repurchase agreements. So these are temporary collateral loans, and these loans are tied, the collateral is a U.S. Treasury bond. And it amounts up to about $1.6 trillion that the Fed is temporarily sucking out of the banks and then repurchasing those bonds back the very next day. But since they've been doing this day after day after day for the past 6 to 9 months, and really they started doing this in the early parts of 2021, but they've just ramped it up for the past 6 to 9 months, means effectively that we have about $1.6 trillion of extra liquidity inside the banking system, okay? And so we have to add that onto total reserves. So the total reserves of our depository institutions, or our banks right now, was about $3.9 trillion in January. Now they've dropped to 3.8 in February, but I'm using 3.9 as sort of the starting point. So already the Fed's rolling back of their purchases is starting to drain on these bank reserves. So once this repo market drives up, and once these bank reserves dry up, which adds together to a total of about $5.5 trillion of liquidity inside the banking system, once most of that dries up, say $5 trillion of it, and the banking net reserves gets down to about, say, $0.5 trillion or less, it's going to reach a critical point where banks are just not going to have the reserves enough to maintain daily operations and keep the flow of money circulating to borrow temporarily and create long-term loans. They're going to have to cut short those operations, which is going to lead to disruptions in the market here. And as I've said before, the big take on that is the government debt that is levied on this banking system. So the Fed has been purchasing a lot of this government debt for the past 2 years. Now that the Fed has stopped doing that, and even more so is going to start selling some of their debt that they've already purchased from the banks back to the banks, that's going to quickly draw down on these bank reserves. Now, I'm not seeing it yet in the overnight repurchases starting to drop, but we should start seeing these repurchase agreements drop off as reserves become dried up, and it starts putting upward pressure on the overnight interest rates. And once the Fed sees that those overnight interest rates have reached a sufficient point that repo treasuries no longer need to be sold daily, that will then drop off, but then that will remove that barrier to the bank. Now, we also have to factor in required reserves. So banks are forced to hold a certain amount of reserves on hand. It used to be that we could calculate what these required reserves were. For the Fed would keep statistics called excess reserves of depository institutions. So if we were to go to FRED, Federal Reserve Economic Database, and look at excess reserves of depository institutions, this is the amount of extra liquidity that banks have that they're not required to keep on their balance sheets, that they were stocking away as a safe haven at Fed accounts. Unfortunately, in the latter part of 2020, the Fed has discontinued this excess reserves. So what I have done is approximate what the required reserves were and subtracted that from total reserves inside of our banking system. So I've extrapolated to what the required reserves were in September 2019, which was about $300 billion. I've extrapolated it to now and figured that probably more or less based off of bank balance sheet data, we're probably at about $400 billion because essentially bank assets and bank liabilities have increased by about 33% since Q3 of 2019. So, saying all of that and accounting for that, that also has to be taken away from this amount of excess reserve data inside of our banking system. And essentially, this is what we need to keep an eye on. Once these reserves start to get depleted and we subtract out the required reserves, once this gets down to, say, about $0.5 trillion or $1 trillion, a little bit underneath that, give or take, that's probably going to reach a critical point for the banks where we are really staring in the face the potential for bank runs, much like what we saw in the early parts of the 20th century here. The Fed was actually created and designed to stop bank runs. Ironically, we got the worst set of bank runs caused by Fed policies in the 1930s. Now, what does that mean for today? Are we looking at the set of bank runs? Well, probably not. But what it does mean is that the Fed interventions inside the market here will cut short the Fed's tightening of monetary policy inside of containing price inflation here. Now, I've created a sort of long-term price inflation formulation figure here that sort of kind of extrapolates what we're going to see annualized inflation rates over time. And essentially, based off of monetary data, the increase in the money supply, and factoring in historical increases in quantity goods created, which is just nominal GDP divided by the historical CPI, we're probably going to see inflation, increase and stay relatively high until the end of 2023. And only then, and that's barring outside of any kind of, extraordinary situations, only then will we see inflation start tapering off. And again, this is not really factoring in what's going on with Ukraine and Russia and those types of situations. As I mentioned at the beginning of this video, that's impossible to calculate. That really is. It's impossible. You either think it's going to have an effect or not. It most certainly will, and it most likely will have a higher inflationary impact on the CPI, especially in the next few years. But to what degree and how much and how to calculate and extrapolate is beyond my comprehension. The only thing I can do is give you what the base the base lookout is, and that's, absent of any type of geopolitical forces or acts of God. So based off the economic performance, which is essentially just the money supply, we are looking at a huge increase in price inflation for the next couple of years. Now, the Fed has started to engage in relatively quantitative tightening. So what I have done is went back and took into account what the average growth rate of the money supply was the last time the Fed did quantitative tightening. And long story short, it amounts up to about 0.3% per month, give or take, maybe a little bit more than that. Once you factor in that 0.3 plus percent per month, and you factor that into the money supply, you can then take the historical quantity goods created and that growth rate and extrapolate out what the price formulation should be. That's this green line on this chart here. So right now, as of the beginning of 2022, this is where we are on the price formulation and actual annualized consumer price inflation since the beginning of 2020. You can see that there's this huge divergence between the two lines, and this is typical because the Federal Reserve's monetary policy was extraordinarily inflationary in the beginning parts of the pandemic of 2020 and carrying on into 2021. Now that monetary inflation is beginning to die out and we're starting to see a rise in the consumer price inflation index, we're seeing a merging of these two lines. And based off of my analysis here between the price formulation calculation, which is what I'm using for this green line, and the actual consumer price inflation, historically speaking, over the last 60 years, the two run very close together. And assuming that's the case, then, based off of historical performances that Federal Reserve actions have had on the money supply, this is most likely what we're going to see, or something similar happen with the CPI. So the CPI annual inflation rate is probably going to peak in the early part of 2023 and then slowly drop off from that point forward. So the prognostications that we're going to be down to normal inflation by the Fed and by the government in 2023 is ridiculous. That's not even close. And this is assuming that money supply growth drops down to 4%. Money supply growth right now is about 11 to 12%. I am anticipating that money supply growth will drop down to about 4% year over year. And only then will that relative drop in the money supply growth rate, only then will that start dragging down consumer price inflation. And it will be a slow dragging down because, again, we're having huge amounts of government spending and debt trying to increase consumption. And unless those numbers start changing, then we're probably not going to see any severe drops in the money supply, and therefore not much of a correction in the consumer price index. Again, as I've said before, this is not taking into account the effects that sanctions and the Russia-Ukrainian situation has, because, again, there could be other things that affect this matter. Again, we're not taking a look into what's developing with China and Taiwan. If a war breaks out between those two countries, that could cause further disruptions, and it would skew this CPI inflation rate higher than what it otherwise would be. And that's just impossible to calculate. I can't do anything about that. All I can do is just give you this estimate. Otherwise, outside of those events. Long story short, even though we might see some calming inflation rates going down, this isn't taking into account the strain that tightening Federal Reserve policies plus excess government debt is going to have in our banking system. And then more than likely, the Fed will have to bail out the banks. They'll have to engage in repo markets, and we'll probably start seeing the money supply ramp up in 2024, which I have not increased. I have not anticipated onto this, but if I were to try to anticipate that, and as a matter of fact, I could probably do that now, let's take a look at what happened with money growth when the Fed had to reverse its policies in 2019. Looks like money growth was averaging at about, say, 0.6 to 0.7% per month. About, say 0.6, right? So that's going to amount to about 2% per quarter here. And if I were to factor that into this calculation, then it will probably result in close to, say, an 8% monetary money supply growth rate year over year. And that will make the price formulation chart look more like this. And if that's the case, then, based off the CPI, we're probably going to be seeing something that is, a much higher than what we were seeing before. And the CPI is probably going to flow more like this and possibly even more so. Let me see here. Let me adjust it upward a little bit more. I'd say that historically, it's probably going to function like this. So if the Fed has to bail out the banks, if it has to reverse its operations and start supporting the banks, then we're probably going to see annual inflation rates, stay relatively high at 5% or higher for the rest of this decade. And, that's not counting any type of credit crash that could happen still from tighter monetary policy. That's just going to be more difficult to calculate, because essentially the rising interest rates policies that the Fed has, it will have to reverse to shore up the banking system. This is leading us to a serious problem here, where we're going to have a lost decade due to high inflation. This high inflation will lead to higher interest rates than normal, higher prices, and it will result in diminishing investment opportunities, and will probably lead to a bullish gold market for the 2020s. That's basically what I'm seeing from all of this, and I just don't see any way out of this. I really don't. I mean, I could be looking at this from a two-dimensional perspective, absent of some kind of magnificent technology increase that results in a boom. I don't really see anything out of this unless if the Fed is daring to instigate a crash and correct these really, really bad loans that have caused a lot of malinvestments in the economy. I'll go over a little bit about that in a coming video about the theory that how the business cycle normally plays out, but this is an abnormal event. And the reason why is because essentially draining bank reserves from excess government debt is actually cutting short the business cycle. It's not allowing the business cycle to manifest completely in the result of a bust. And the reason why is because the bust is now in the banking system, and the Fed will not allow the banks to go under. Everybody is dependent upon the banking system. To do so means that many depositors, many savers and investors will lose out on their cash holdings, and it will cause a severe economic crisis, the likes that we have not seen since the Great Depression, and the Fed is just not going to tolerate that. The Fed is basically going to be forced to choose between the great inflation of the 1970s and the Great Depression of the 1930s. Given the choice between the two of them, the Fed is more than likely going to choose great inflation. So I want you guys to think about that and mull over what I'm giving you on this, because essentially speaking, what I'm outlining here is a long-term forecast that I just don't see it manifesting any other way. I mean, we could get some bust in between here and there, but it will more than likely be against Fed monetary policy. It will not be because of it. It will be despite the Fed trying to shore up the banks. And I'll give you the updates on that as time goes on. Like I said before, I've created a default rate model. I've adjusted for the time lag, so I feel pretty confident about this. So I'll let you know when we've reached that critical point where defaults have reached, defaults on loans have reached such a point that it is going to be indicative of an economic crash. So stay on the lookout for those videos in the coming months, in the coming years. If you haven't subscribed to my channel, now's your time to do so, because I'm really the only one here, as far as I know, that is going to give you the inside statistical look on this data. And until we start seeing a divergence between what manifests out in reality and what the statistical model chart is showing, I'm going to stick to this, and I'll give you regular updates. So stay tuned for that, and stay tuned for future videos. Next week is the final GDP numbers are going to come out, as well as the gross output numbers. I'll update some charts for that, produce a video on that, and then we'll probably get some unemployment numbers. That's going to be curious for us to see about how unemployment has handled in the wake of the first month of the Russia-Ukraine war. And then, as always, stay tuned in the coming weeks for the inflation data. If you haven't watched my previous videos on inflation, make sure you click that. You can always go to my channel and look at the playlist of what I have and look at those previous videos and get your information from there. Once again, guys, I thank you for watching this video. Make sure you like this video and show me some support. And as always, let me know what you think about this. Drop a comment down below. Curious to know your thoughts on this. Until next time, I'll talk to you then.